Welcome back, folks. So we're going to be talking about a concept that's near and dear to me. It is the T.G.I.F setup, or Thank God It's Friday. Now, this is a day-based algorithmic ICT trading model, and you can use it on all assets. All right, so as you may have already noticed, this is a day-specific model. That means the model will appear one day per week. It's on the Friday, hence the name, Thank God It's Friday. And it's a pun on the expression we say here in the States, TGIF, Thank God It's Friday, meaning that you survived the work week and now you can party and rest on the weekend. But the pattern and the characteristic of this pattern is a retracement into the current weekly range. And I'm going to talk a little bit about the weekly power 3 and the distribution phase of that. So let's take a look at the NASDAQ futures contract. This is a 1-month chart. Now, obviously, we want to do a top-down approach when we're doing our analysis, and the TGIF trade is going to be extremely precise if you are anchoring it against some higher time frame, premium array, or discount array. Now, I'm describing a premium distribution, meaning that the assumption is the market has been going up, and we're going to be looking for some measure of exhaustion for the weekly range, and then it will pull back into said weekly range. As you can see here, the monthly chart for NASDAQ, and for those that are just watching this video in the future, I'll count you to go through and look at the dated analysis and commentary videos I placed on my YouTube channel that were focusing on how NASDAQ and all the stock index futures were called higher. So you can see here on a monthly chart, right here, we can see a small little imbalance in the form of a fair value gap, sell side imbalance, buy side inefficiency. That's defined by these ranges extremes, which is this month low, this month high, this only portion on the downside or sell side delivery, it would be requiring buy side delivery. So you can see buy side being offered here in the month of June 2023. So this is a premium fair value gap on a monthly chart. So with these levels in mind, let's drop down. Okay, you can see how on the weekly chart now, you can see the weekly. And those respective levels here from the monthly chart, you can see we did in fact reach up into a monthly premium fair value gap. The high of that fair value gap is here, and the low of the fair value gap is there. Okay, and it's linked directly on the monthly chart, but then dropping down to a weekly chart, it's going to look like this. So it doesn't look like there's a fair value gap at all on the weekly, but it is on the monthly. So we have to do our top-down analysis, and the hierarchy of my premium and discount arrays will work from higher time frame down to lower time frame. So you can see it is Monday, so the last week of trading, this is represented by that week here. So we've started a brand new week. So we're going to ask all of you in the audience to disregard this little candle, just ignore it while it's being shown in the charts, because I have no way of taking that out. Okay, so you can see we did reach up into a premium fair value gap. Now, when it does that, it's very likely to see some measure of pullback, and you can see as we hit up in the upper end of this premium fair value gap on the monthly chart, but now we're showing it on the weekly. We went up to it and then came back down towards the low end of that range. Okay, and that range being, again, that fair value gap on the monthly chart. So let's take a closer look here and drop down into that little section of price action and take a closer look. Again, you can see zoomed in on the weekly chart. Doesn't appear like there's a fair value gap. The market trades just shy of that low, which would be, again, the monthly premium fair value gap high, or the highest part that makes a fair value gap that was referencing the monthly time frame. There's a small, tiny little imbalance in here. I'm going to reserve commentary on that. So just focus on this area right in here, okay? And notice how we've had multiple weeks of NASDAQ going higher. I've been counseling you to anticipate NASDAQ being the upside leader across the three averages, Dow, S&P, and NASDAQ. NASDAQ being the leader issue on the upside. And it has performed stunning fashion to the upside, outperforming the ES and outperforming the Dow. But I want you to take a look at how each one of these weekly candles are created. True, they're all up close candles, but notice where the close is. It's above midpoint of the candle's entire range. The close is near each candle's high. This candle here closed near the high. It closed really close to the high, close to the high, close to the high, and close to the high. So I want to talk a little bit about my Power 3 concept. Now, I'm not going to go into great detail here, but I do have lectures on this YouTube channel that cover this, and it's mentioned and laced throughout a lot of the teachings. So I'm a firm believer of repetition makes mastery. You have to see things over and over again to condition your mind and your eye to see it. You can't just watch a video, and you can't watch a 5-minute trainer or a condensed version of what I'm teaching, because while you may feel like you watched a shorter version of my content by someone else, that is not teaching you anything except for the same thing you get with Cliff Notes. Okay, it doesn't compare to the full detail. So Power 3 is not linked to any one particular time frame, but when I first introduced it, it was appropriate at the time to teach it on a daily chart. Okay, so let's look at this with the reference of a weekly range. The low of the week, where we started trading here at the open. In other words, this is an open, high, low, close bar. Most of analysis is done on candlesticks today. Okay, I know I have moved away from this type of chart, which is how I used my commodity charts and S&P charts and bond charts back in the mid-90s when I first started trading. Then over the years, my eyes have, unfortunately taken a toll at looking at screens for a long time. It's a lot easier to read the data with a candlestick now. But from a Power 3 stance, the open, the decline below the opening price, the rally higher, making the high of the day, and then the close near the high of the day. This is Power 3, where we anticipate the market moving higher on the basis of a weekly analysis, higher time frame analysis. We think that it's drawing to a premium array, something to make it want to go up here or draw to it. And so on Sunday when the market's open, we anticipate, if we're bullish, that opening price or this opening price at midnight New York local time. It can open, drop down. We would not see that as bearish. We would anticipate that. So it's the accumulation phase below the opening price. The manipulation is the open and then decline, but we're utilizing that function to accumulate long positions. Or, for the purpose of studying, we would anticipate it opening, trading down into some discount array. What would that be? A fair value gap, running short-term sell stops on a lower time frame, trading down to an old high, something that would promote some discount or quote-unquote a support level. Then the market would displace higher above the opening price, return it into some kind of imbalance that would be seen with a bullish fair value gap or a bullish breaker, and rally up. So this is the expansion portion of Power 3, then creating the extreme high of the week, and then trading off that high to close. And this would be the distribution phase of Power 3. So it's open, high, low, close, accumulation of longs at that opening price and down when it drops below it. This is manipulation. This is where retail traders would chase that move lower, and then they get raked across the coals as the market goes higher, reaching towards some higher time frame premium array, some kind of target. Okay, think of it like I've outlined here. The market has been drawing each week up into this area here. Well, that's each one of these open, high, low, and close would be represented by each individual candlestick here. So even though these are candlesticks, This candle here would be represented by the open, then it traded down, then it rallied up, made the high, and then came off the high and closed near the high. Same function, but I'm teaching Power 3 with this open, high, low, close bar. And obviously everything I do is reversible, just whatever I've said in previous. For when it's bullish, you would just use it when it's bearish. You would open the accumulation of short positions when you think the weekly candlestick is going to go lower, reaching for some kind of discount array, some kind of sell side liquidity, something to that effect. You would see the opening price and then rally up. We would see this open as accumulation of shorts and then manipulation higher, tricking retail traders into thinking it's going to break out to the upside. Smart money would accumulate short positions here and then ride it down throughout the week, reaching to some discount array, and then before the end of the week it comes off the low, closes on Friday's close, near but off the low. So I want you to understand that premise. Now this theory of mine is not limited to a weekly, it's not limited to a daily chart, it's on every time frame. Every single time frame. So as long as you know where the next draw on liquidity is, regardless of what time frame you're trading, what style of trading you're utilizing, this idea of understanding accumulation, manipulation, and distribution will serve you well in terms of finding setups, sticking to institutional order flow. In other words, trusting that price is going to continue moving in your direction if you're on side. If you're off side, it means you're incorrect about what you think is going to happen in the marketplace. Then you're obviously going to get stopped out, and that goes without saying. But assuming all things equal, if you're right, this is how we interpret price action. So I want to take your focus into that very range right there that is encapsulated by a down and up arrow. So this weekly range here, okay? We're going to look at that. We're going to zoom in. With this range in mind, I want you to think about how without those levels I have drawn on the monthly, you can see how if you don't have those reference points, it's kind of hard to determine what it would be reaching for. That's why you want to spend the majority of your time on a higher time frame charts, because the market's going to gravitate towards these higher time frame premium arrays or discount arrays. And if it's drawing towards a premium array, that means that the bias is going to be primarily bullish. Each day of that week or the week to come, you would be anticipating any decline is to accumulate long positions and then distribute those long positions to a premium array. So that week right there, let's zoom in. All right, and I'm using the continuous contract here so that way you can see the distinctions or the similarities. Right now it is mid-June 2023, and this is the NASDAQ weekly candlestick. So the low of the range is marked here. It is not the opening price. So the low of this candle is not the open. The open is just slightly above the low. You can see that small little separation there. And then we have the run higher, makes the high of the week, and then we close here on the week. T.G.I.F, or Thank God It's Friday, is a setup that I've codified for end of week range concepts. I don't want to say reversal pattern. Sometimes I have mistakenly referred to it as a reversal pattern. It is a reversal pattern in the sense that in the last portion of Friday's trading, you can, if it hasn't occurred yet, you can anticipate some measure of retracement into the weekly range. And when I say that, what do I mean? The lowest low of the week, all the way up to the highest high of the week, that's your weekly range. Okay? Now let's assume for a moment that it is 2 o'clock in the afternoon, New York local time, and you're trading or studying the index futures, and it just so happens to be we're looking at the NASDAQ. I taught that there is a PM session. Okay, between 2 o'clock and 3 o'clock, there is a formation that I dubbed the ICT Silver Bullet. Okay, I codified that as well. I've already shared an introductory lesson on my YouTube channel. I will be teaching more about that as we go along, and there'll also be some more tips and tricks with it in my books to come. But you won't need the books. I know that sounds like a plug. Go buy my books when they come out. The first book will be released when I get to 1 million subscribers on the YouTube channel. I get a lot of questions as to when it's going to be released. That's the timeline. And then 6 months after that, the second, and then going in perpetuity until we get to the final 4th book. So the range for that entire range of the weekly low and the high, when we assume that there is a high formed for the week. Okay, and we can assume that is the case when we get to about 1:30 or so on Friday. And then we can anticipate some measure of retracement into the weekly range if, now again, this is a major point that needs to be required in the analysis, if the market has reached some premium array. If it has not reached a higher time frame premium array, then it could continue into the close and close right on the high. So that's how you distinguish whether or not it's going to form or it's going to keep on going and close right on the high. But because we traded up into that monthly fair value gap, and because we have been trading up for a long series of weeks, each week being bullish, we've maintained a bullish delivery, and we have been maintaining a bullish analysis on stock index futures over the last few weeks. So none of this has taken us by surprise. But I want you to think about when you anticipate a high of the week is probably in, and I'll talk about that when we get into lower time frames. For the sake of conversation, let's assume for a moment that you had the ability to determine that there was a high already formed, and now anything going into the close on Friday of this week inside this weekly range. Okay, try to ignore this one here. So I had to take the screenshot of this chart, and it obviously shows the new week we're working off of now. So this range here, we're not even concerned with this. We're only looking at the high of this candle and the low of that candle and the respective levels that's being identified here. So the high of the week range and the low of the weekly range, if you measure with a Fibonacci from the lowest low all the way up to the high, now you would be doing this intraday as you approach the afternoon session. Doesn't mean that you can't see this T.G.I.F pattern form in the morning session. It's more likely to form in the afternoon, especially if we had continuation on the upside in the morning session, then it's more likely to create it in the afternoon session. But the range high and the range low, if you put a 0.20 and a 0.3 level on your Fibonacci, that's basically giving you the 20% and 30% demarker for the entire weekly range. And that's the only thing that's being shown here. I'm denoting where 20% of the range from the high down to the low, 20% of that range is here, which will be 15,326.75. And then 30% of that range would be 15,252.5. So those two levels here, that is your sweet spot. Okay, that's where T.G.I.F will likely draw into. There are times when it can draw into 40% or more. That's more of a conversation for reversals or market tops or bottoms. But we're going to reserve that for another time because it's outside the scope of this discussion. Meaning that if we can watch price delivery on Friday, whether it be in the morning session or the afternoon session, if we get to some level of a premium target being reached, or as we saw on the monthly chart, we traded up into that fair value gap. The day of the week is Friday. It's been going up every day. So it's within the realm of reasonable to anticipate the market drawing back. Okay, so the fact that it's dropping down, I learned, I'm sure you've probably heard this also in books and such, and other educators, it's profit taking. And I have been guilty of using those terms early on in my career where the market would be dropping lower and I would assume that that is profit taking. And I don't believe that is the case, and I'm not going to try to sell that to you. It's my argument and case that I make that these markets are algorithmic and everything happens because it's designed and engineered to do such. So if there was an algorithm, and I'm going to assume for a moment some of you don't believe there is one that's running the marketplace, then it wouldn't do some of these types of things. But if there is an algorithm, then it should do these types of things, right? That's my argument. I'm not trying to be dogmatic about it here, but I just propose the idea so that way you can go into price action with that in mind when you're studying it. So if there was a reasonable means of measuring or a macro, a short little list of directives that the algorithm would follow to reprice from the highest high of the week down to some predetermined price. What would that be? Well, we're going to walk through that here. But the bullseye, if you will, the little sweet spot that the market can retrace down into. In other words, we don't anticipate it closing right on the high. So if it's going to come off the high before Friday's close and ending the week of trading, it's going to stop somewhere between the 20% and 30% range. Now, right away, this is going to sound like, oh, here we go. We got a cherry-picked example. But I promise you, I have very, very long-term students that have learned this from me years ago. And they see me do this with the daily ranges. They see me do this with the weekly ranges. And they're able to do it as well. So I'm teaching you the concept and the building blocks to understanding it. But there's a lot of other things you can do with this information. But this is just an introductory to the T.G.I.F setup. So here is that same idea now being applied to the, and on TradingView, if you're following along on that, that's the teaching medium I use, and pull it up on a weekly chart, you would see that this range, again, disregard this. This is the new week candlestick, so we're not worrying about that. We're talking about last week and how we could have used this information on Friday. I promise you, buttons were pushed on Friday. You're going to see the execution. But I'm teaching you conceptually what was in my mind, how my students also know about this pattern as well, and how we look for it. So here's 20 and 30% of that weekly range from the high, and those levels being shown here: 15,326 and 3/4 and 15,252 and a half. All right, here's the NASDAQ September contract daily chart. All right, we can see that this candlestick here makes the high of the week, and the high comes in at 15,475 and a half. And then we trade down into the range between 20 and 30% of the entire weekly range, the weekly range being the high here and the low here. 20% of this entire range here subtracted from this high would give us this level right there. And then 20 and 30% respectively would be that T.G.I.F draw on liquidity. Okay, so think about it like that. The market will likely draw down to 20 or 30% of the weekly range. So that's how we can anticipate Friday's trading in terms of a intraday reversal or a weekly retracement. I'll leave it up to you how you want to classify it. Okay, either one of them would be considered correct in terms of describing what it is you're trading. Monday's trading here, Tuesday's trading, Wednesday, Thursday, and then Friday opening, making the high of the week, and then trading down and closing inside that 20 and 30% of the total weekly range. That is a successful T.G.I.F trade. Now let's go into the details with this a little bit more. Right here is an hourly chart. Okay, you can see how, again, we had a short-term high, we rallied up. Don't look at this as support because we don't know what the high is yet. So I'm just showing you these are the levels that once the high is in place, and we can anticipate it forming in the lunch hour or just before lunch, around 1:30 going into 2 o'clock, the assumption is that we're likely to draw down into 20 or 30% of the weekly range. If we've been bullish, and we've been bullish for a while, and we hit our higher time frame premium arrays and targets, so it's reasonable for it to draw back. If it's going to draw back, it's going to do so in a controlled manner because the market is algorithmically delivered. So price is controlled, it's following a script, so therefore where can we anticipate the market to draw down to if a retracement is in fact what's going to come in before Friday's close? We have to define where the weekly high is. The low is obviously here, it formed on Sunday. So Sunday at 6 p.m., we're seeing that candlestick here represent that weekly range low. And then we can see Friday, all that range in here, the highest high, we anticipate that high forming Friday morning to Friday lunch, or certainly between 1:30 and 2 o'clock. Why? Because it's likely to retrace into the close. Now, in terms of keeping things easier for some of you that are I guess, familiar with trading and some of the terms that are used, unfortunately, incorrectly, they'll say profit taking's coming in and the market will retrace lower. And it's not an absence of buyers, and it's not the sellers overtaking buyers. It's absolutely controlled. The market will just simply gravitate towards 20, 25, 30%. And sometimes if it goes beyond 30%, that could indicate an all-out reversal on a long-term basis. I don't suggest that's the case here today because today is a holiday and we've only had a short span of time trading where on a holiday we only have like until 1 o'clock in the afternoon or so the futures are trading. So I don't suspect that we've created the high yet. That could obviously be different when we open up later on this evening to start a full normal session, to start our normal week. So that's our weekly range viewed over the scope of a hourly chart. Okay, so we're going to get into this and get a little more detailed. Dropping down inside that range and zooming in towards the high end of it, this is the 15-minute candlestick chart. So 15 minutes, we can see that the high forms in here around the 9 o'clock in the morning hour on Friday. It rallies up, creating what? A Judas swing. So all this initial run here sucks traders into thinking it's going to go higher. It's been going higher. Don't fight the trend. Don't fight the Fed. Don't try to do this. Don't try to do that. Everybody has an opinion about what they should or shouldn't do. But if they don't have the rules of engagement that the algorithm is employing, all of the ideas or the dogma that every trader has and subscribes to as a religion, whether you want to believe it or not, your trading system is a religion. You have faith in it. You're investing in it. You're paying tithes to it. So the bottom line is all of this deciding of taking on risk, it's going to have to be rooted on something that makes sense. And I don't believe that buying and selling pressure is the sense behind why price is going up and down. It's 100% controlled. So if we can see that initial surge at the open on Friday, as we see here, the market runs up, creates this tendency to want to expect it to keep going higher. An old high is broken here, but I teach that is buy-side liquidity. So the market goes higher to run out these relative equal highs because those pending orders that would be used for traders that trade on a breakout, they want to buy strength. Smart money employs that as their counterparty to going short. And they're going to trade with this in mind, 20 to 30% of the weekly range. T.G.I.F, thank God it's Friday. There is a systematic approach to trading these types of days on a Friday where it trades back to 20 to 30% of the range. What does it look like? Well, everything I've already taught you. But the premise is why and when it will reach for that 20 to 30% range of the weekly. Highest high and lowest low of the week. Look what we see here, 15-minute. Last up close candle, prior to this move lower, this displacement here, the change in the state of delivery is the opening price. That is my ICT order block. Okay, it has nothing to do with an FU candle. Okay, you see all these people trying to add things to it or change the name of it. There is no FU candle. Okay, it's not an engulfing candle. It has nothing to do with any of that. The fact that the market is likely to create the high here. See, I already know that this is going to form because of that fair value gap on the monthly chart. We traded up into it. I know I'm talking very assertively, aren't I? I brought receipts today, I promise. The up close candle is what we're measuring, whether you want to have the wherewithal to go short up in here or not. You don't need to. You want to wait for it to displace. One big candle up, and then it runs right over top of it. That opening price is where the change in the state of delivery is made when it goes back through it, which is right here. Then we have a short-term low taken with this candle, and it closes and creates another candle here. And then as soon as this candle starts trading, we have what? That's your 2022 model. So no matter how you slice it, okay, I have so many people that will come to my channel, or they'll commentate around my content. They'll either be supportive of it, or they'll try to take shots at it and say, I don't like him because he has this, he talks too much, he doesn't really have this or that. I have a lot of things, and it's imperative that you go through all of it, because you're going to see how all of it fits together. The T.G.I.F is a strategy that you anticipate price delivering to. In other words, it's a draw on liquidity. That's all it is. And it happens on a Friday. And it reverses whatever has happened on the weekly range. It's going to go back into 20 to 30% of whatever that weekly range has done. Is that complicated, folks? Does that sound complicated? Because it's not. It's really easy. But how do you trade it? How do you go in and implement it? Take it and go out there and study it. You go through the process of everything I've already taught you. You could trade the turtle soup, which is the run here above the buy side. So when the buy side's taken, you can sell short right there. That's a very, very difficult thing to do for new traders. You have to really trust you know what you're doing. You don't need to be able to do that. Wait for it to give you your 2022 model. Here's your fair value gap with the short-term shift in market structure here, or if you want to use that one, either one, it validates it. Then it trades up into what? The 2022 entry model. So it's trading in this little area, and because we have to traverse over lunch, that's why we have multiple passes during the lunch hour. Nothing has changed. Treat this candle and this candle, and the highest one that trades into it, which is this one here, until we take out the low here, and as long as we don't take out this high, all of these candles in between are all time distortion. The range is already defined. 2022 model. I teach more about time distortion in my books, by the way. I'm not going to teach it on the YouTube channel. I'm not going to teach it on Twitter, because some of the things that I teach, there's people out there already taking my content and trying to write books and get ahead of me, and they're writing them incompletely. They don't know the details that my books are going to have. So it's just a money grab for them. I don't want anybody looking at me as a cash cow because of my ability to teach this well, and other people that learn from me are making lots of money now. I want you to learn it properly. But you aren't going to learn it just by one covering of it, okay? Whether it be by me or someone else. No one's going to teach it better than me, because I authored it. I codified these concepts. You're only being introduced to them. And don't fall victim to thinking you're going to hear somebody tell you in an abbreviated format, this is how you do this and how you do that. But I want you to see how all the things that I teach, you can find them throughout larger fractals and price action. That means there's more than one way to skin a cat with my concepts. Just like there's other ways that people can trade and they can find themselves, and that's fun. That's wonderful. But with my concepts, you don't have to be a one-trick pony. There is not one PD array, not one model that is superior to the next. It's whatever one that you feel comfortable with, the one that makes the most sense to you. Okay, so obviously you can see how we moved from this area here, this fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency. So this move down here, separated by this candle's low and this candle's high, all the sell side needs to be what? It needs to be delivered with buy side. We see that here. But look how many times it's doing it. Why is it doing it that many times? Because it has to traverse through the lunch hour. The lunch hour, there's a macro that runs within the lunch hour, and it usually runs what? The stops. So where would the stops be? Right above this high. We see it run there, and we return back to here, but there's no necessity to get above it. It's just respecting with these little mohawks, these little tiny little deviations outside of the range that creates my fair value gap. This low. So it goes above it here a little bit and a little bit here. We expect that. We anticipate that type of thing. It does not undermine the overall scenario. Then you watch price melt into the 20 to 30% of the range before Friday's close. And that would be the shaded area here. Zooming in here, again, you can see this is the 15-minute order block. And we're trading up into that shaded area that was found and defined on the hourly chart. You can see we have that run on the stops here. Then we drop down, take out sell side, and then one more time rallies back up to the 15-minute bearish order block. So this is a reclaimed bearish order block. Sell side's below here. The market drops. Here's the model 2022 again. Short-term low. Drop. Fair value gap. Rally up. If you don't get that entry, okay, because it's before 2 o'clock and you have a rigid rule set now that you're going to be algorithmic behind every trading idea that you employ, whether it be paper trading, studying, or live trading, you're going to stay within these sweet spots in terms of time. I've already taught between 2 o'clock and 4 o'clock, the afternoon PM session. You can find a trade, or price run that will seek liquidity. It's Friday. The market has shown a willingness to do what? Give a Judas swing in the morning. We're seeing that here. This is a Judas swing. Then it overlaps all of that. There's a change in the state of delivery here. That's your bearish order block. We have a Model 22, 1 hour fair value gap in the form of a SIBI. That's this shaded box here. And then we hit the bearish 15-minute order block again. It drops, creates a fair value gap. It's also a breaker. High, low, higher high. How many models have I shown you already? Which one would you have taken? That's the part that makes this complicated. I don't make it complicated. I don't complicate it. Am I detailed? Yes. But notice that if one of these patterns and whatever it is premium array that you're going to identify as yours, you already see that the one that you like, you would be utilizing that. And the other ones aren't so important to you. So you're able to see what I'm talking about and find what it is that meets your model. I'm not trying to press you into a mold where you only do this entry technique. You don't only do whatever I point to. You find your own model using my concepts. And there's no better way than another. Don't look at, okay, well, if I sold up here, that would be more money than entering on the fair value gap here or trading into the breaker here. You may not have recognized this as a fair value gap, but you can see this high, low, higher high, the down close candle here, extend it through, and it's trading onto it here and here. That's a bearish breaker. Now, other students here would see, okay, I see the run on stops. It breaks lower. Here's a breaker. It trades up. I would trade that as a breaker. Another student may see there's a breaker there. There's a fair value gap here. I'm going to split that up into 4 gradients, and I want to take my entry in the lower portion of that, in the lower half of it. And we have a fair value gap here, so I can trade into that. And in 25% of this range from the high and the low, that 1 hour fair value gap or SIBI, that's what this area is here. You'll be trading off that gradient. Again, how many models have I shown you here just in this? It's not a one-hit wonder. The premise is that there's a high forming when it's been bullish all week long. And we're going to trade off that high down into 20 to 30% of the range. That's all T.G.I.F is. T.G.I.F is not finding the right PD array in the move. I'm giving you that freedom to pick which one you're going to use. Now watch. What happens if you've seen all this stuff in hindsight while the market's trading right around in here and you missed it? It's already traded outside of the fair value gap. You missed it. What can you do? Well, has it traded to the 20% yet after leaving the fair value gap up here? I mean, it hits it here, yes. But we still have time. It's still a little bit after 11 o'clock in the morning on Friday. We still have the whole afternoon and lunch session to still go through. So what does lunch usually do? It runs stops. So we're expecting and anticipating a rally up to clear the board of any trailed buy stops. Does it sweep that high? No, it doesn't need to. But it will run rejection blocks. Now, in your notes, rejection blocks are the same function as running out liquidity. What's the highest up close? This one here? Prior to this high here. Is it here? No. There. Extend that through in time. You can see we sweep that. It does not require it to go above this high. We're trading inside this wick, which is what? A gap. So because we've seen it create a little mohawk outside the 1 hour fair value gap, it's also defined on that 1 hour bearish order block, the opening price. So we anticipate that little movement outside of that. It's reasonable. We don't want to see it, but if it happens, we're not freaking out. So since we created this little deviation outside that gap, returning back to it is permissible. Notice where the bodies are inside of that 1 hour fair value gap. The wicks do the damage. So how do you cut through all this stuff if we already anticipated a run in permitting a mohawk, a little tiny little coloring outside the lines, if you will? We have to look in here. Where is the rejection block? Think about your PD array matrix I taught you in core content month 4 on this YouTube channel. There's your highest up close. That's your rejection block. Extend it to the right, and that's, you see what we're doing? We're wiping that out. It does not need to take out the wick high. Rejection blocks are a very instrumental part for me utilizing time distortion. And I promise you, I'll give you more details, but it requires a lot of other things for you to take anything away from it. Don't listen to anybody out there doing time distortion lectures because they absolutely have no idea what they're talking about. I promise you. So getting back into this fair value gap here, if you want to utilize the T.G.I.F and you anticipate it drawing down into 20 to 30% of the range of the weekly expansion that you've been witness of, whatever that week would be, any future week, you can utilize this information, okay? You missed the ideal entry inside the fair value gap. It moves outside of it. Can you participate? Sure you can. We're dropping down into a 1 minute chart. Here's that fair value gap that was on the 5 minute chart. You saw we hit it here at the low end of the 1 hour fair value gap. That's this shaded area here. And now we ring in the 2 o'clock time period, which is this bullish candle right there. That's 2 o'clock on Friday. And then we drop down. So what did I teach you about 2 o'clock to 3 o'clock in the afternoon on index futures? My ICT silver bullet. Well, here is the ICT silver bullet. We have a high, low, higher high, reacting off of an hourly bearish fair value gap in the form of a SIBI. We have a fair value gap here. So is order flow bearish? It sure is. It's respecting every premium array. Small little fair value gap here, goes into it, rebalance, in the bottom end of that hourly fair value gap. We would anticipate displacement lower. Boom. Does it happen? Yes, it does. Breaker, fair value gap, trade up into it, get short, reach into the 30 to 20%. How far can it go? Well, you have to wait on time. T.G.I.F, you submit the time. So I'll show you. This is the 2 o'clock p.m. ending. So it's 3 o'clock. So 2 to 3, that 1 hour interval right there. There's your fair value gap that forms the ICT silver bullet. How many models have I shown you just in this lecture? How many opportunities to get in? Multiple. Another one right here. It's still inside the silver bullet time frame. So if you missed this one, you could have done this one. But it hits the 20%, Michael. Wouldn't that be the end of it? No. There's still time. Time ends with this shaded area here at the close. Okay, at 4 o'clock, when that bell rings, you see it on CNBC, ding, 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 everybody claps their hands like they did something special. All this time, you're going to submit to it. And as we get into the last hour trading, 3 o'clock to 4, yes, I understand that trades till 5 o'clock. But the bulk of trading ends at 4 o'clock. Unless earnings season comes in and does something after the bell. But the point is, the majority of the trading is done before 4 o'clock. New York local time. So the entries must be taken between 2 o'clock and 3 o'clock for silver bullet. Okay, so I'm adding all that extra value into this lesson. Here is a 1 minute chart zoomed in. Here's that fair value gap inside of the hourly fair value gap SIBI, and where it bumped the bottom of it and then reacted during the 2 o'clock hour, created the fair value gap with the breaker, high, low, higher high, reaction. We're seeing this is a signature saying that Yes, order flow is bearish. Yes, the algorithm is driving price down towards the 20, 25, and 30% of the weekly range. That's where we'd anticipate it. It gives you a fair value gap. I'm getting short here, 15 contracts at 15,357 even. I want to be ahead of that candle's high. I want to make sure I'm getting filled. That was my entry. I'm holding to see if we get into the last hour of trading, how we trade. We trade into 3 o'clock. We trade half of the 30 and 20, so 25% of the weekly range has been traded to here. Small little retracement, and then I'm anticipating another drive lower. I'm not trying to buy it. I want to see, does it take out that low that's formed in the last hour of trading. Here is sell side. My limit order was placed right there. As it went down into it, boom. I missed all this movement here. That's fine. 20 handlers or so. Then off the low of the day and closed way away from where my cover was. So 15,357 even, short on 15, covering at 15,280 even. Full pull, no partials. That's what it looks like, folks. T.G.I.F. Thank God it's Friday. The pattern or setup is simply using 20 to 30% of the weekly range as the draw on liquidity on a Friday. Okay, on a Friday. If there was no Judas swing at 9:30 when the market opened up on Friday and rallied higher, if it wouldn't have formed that, in other words, if it would have just kept climbing higher and didn't reverse, then I would anticipate a lunchtime or going into 1:30 to 2 o'clock, then create the high of the week. So for some of you are thinking, well, how did you know? How did you know? Or how would you know? One of those two scenarios is going to happen. You're going to create the Judas swing at the open on Friday at 9:30. If you're bearish, you're anticipating it to pull down into 20 to 30% of the weekly range because the weekly range has been going up, right? Well, for this week it has, or last week rather. And then we would expect it to create a false run at the open, lure traders into trying to buy it, and then get trapped near the high. And then they drag it lower into 20 to 30% of the weekly range. Look how close we got to 30% of the weekly range right there. Isn't that crazy? Now, you can have static rules where you can take this 20 to 30% of the range, of the weekly range, and you can do gradients on that again. You can take it, this is the low, the lower 25%, half of it, the upper 25% or 75% of the range that makes up the 20 to 30% range. You can take a partial as it touches 20, take another partial at the upper portion or upper gradient level before 50%. If it gets to 50%, take most of your trade off. Then roll your stop to the most recent swing high and see if it can reach to your next gradient level. And it would have done so here. I just elected to wait to see what this low was that formed in the last hour. This one here had already moved here. So I wanted, in this retracement, I was comfortable with anticipating it ripping lower to take that one out. And it did. And I did not require it to trade to 30%. So what I was using is just simply the low that formed here, allowing traders to think that the low was formed, and they go in, they think they have the 345, 350 algorithm. That's not an algorithm. There's a macro that runs, and when you don't know what it is, you won't see what this is doing here. All this was doing was pulling up against short-term buy stock. Buy side's relative equal highs here, so I knew that it was likely to go up there. But stay inside what range? 20 to 30. So relative equal highs, I was comfortable holding that. That's reasonable for it to go up there and hit that. Then it broke lower, attacking the sell side. So all the people that try to buy long in here thinking they're going to catch a little bit of a move going into the 4 o'clock hour, they have no idea what they're doing. And you can see that there's a distinct difference between what you think you see in other YouTube lessons from other people versus what I'm showing you here. I promise you, if you study this, go back through every single weekly candle on any market, you will see this. You'll see a multitude of potential entry patterns using what I've taught also on this channel. You only need one. You need one entry model. If you want to get really nuts about it, you can have every single one of them understood, but none of you know how to do that yet. Okay, I promise you, if they did, if anybody's out there on YouTube saying they can do it, they know it like the back of their hand now, they know everything I've taught, they would be out here executing like I'm doing. I'm showing you evidence and proof that these things are the reasons why I'm getting in, where I'm holding, what I'm entering, and what the logic was. If they say they know my stuff, they don't. They're just familiar with it, okay? I have a lot more teachings for us this year. Hopefully you found this one insightful. And I really do appreciate you hanging out with me. Until I talk to you next time, be safe.